Okay, well, we might get underway. It seems that a few more people are coming in, but we'll get started. Hi, everyone online. Thank you all for joining us here today. My name is Renee Oldfield, and I'm the Regional Distribution Manager for Vic, WA, and SA here at Charter Hall. Today, I'm joined by Patrick Barrett, our Portfolio Manager for Listed Securities. We're here to discuss the recent results period and how to navigate price hikes and capitalise on those discounts in the AREIT market today. Now, before we begin, I'd just like to walk you through today's format. We won't be conducting Q&A throughout the session. However, at the end, we will have time. So please, as you have questions, just place them in the Q&A section where you'll see at the top of your Teams your Q&A button, and you can add questions there, and then we'll answer those at the end. We may not have time to get through all those questions, so if we don't, we will come back to you, either myself, Pat, or team at the end of the session. So now we'll get started. You ready, Pat?
Thanks,
go. Okay. So Pat, clearly the last 24 months have been challenging for the commercial property market in Australia and around the world. We've just had the results period for AREITs. And what were your thoughts on those results?
Okay, thanks, Renee, and welcome everyone. Thank you for tuning in. So in terms of the latest results, you are right, Renee, in terms of the fact that we have just come through company reporting season for FY24, and it's fair to say it was a mixed result for the broader equities market. There's a couple of charts there where it shows the earnings surprises versus consensus or what the analyst expected. And you can see there that there was a number of firms that disappointed the market coming in below consensus. Many firms commented on increased expenses, whether it be labour, construction, insurance costs. Mainly, the main talking point was the cost of debt. And for the broader equities market, it was materials, with oil prices off 20% rolling year, iron ore's off 35% calendar year to date. So those big global cyclical companies like BHP, Rio, they're down 20% this year. So it was barbell results. There were some very good ones and some ones that disappointed. AREITs were no exception. And when they missed, they were punished by the market. For instance, Mirvac was down 10% on the day of the result. So it was a real mix of results. We've got some good ones. Goodman guided to 9% growth. They under-promise each year, so they probably tend to deliver, at least double-digit growth in the past few years, and we expect that this year. Aspen was 10%, while Mirvac guided to 13% lower, and Centuria Office were down 14% in terms of their earnings outlook. But the good news is, and we think for most of the equities market, and particularly for AREITs, is that they've taken the opportunity to rebase their earnings. And the commentary is that FY25 should be a trough year. And this assumes no reduction in interest rates. So point number one, earnings have rebased for FY25.
That's great. Thanks, Pat. So you just said that you feel that asset values have troughed. So can you give us a little bit more on that, please?
Yep. So the earnings have troughed, but also hand in hand with that is we've seen the rebasing of the underlying property valuations, cap rates. So that's effectively the income yield. If something's deriving $5 of income and the asset's worth $100, and it's a 5% income yield, or it's loose terminology for cap rate. So they've softened about 50 basis points this year, or roughly 10%. The chart on the right, I'll just go to that, shows some of the extreme variations that we've seen. It's been more pronounced in the office sector, and that's, if you read the Fin or any of the major news articles, you'd see that office values have been under pressure since COVID. And some of the valuations have fallen there. You've got Stockland, their office portfolio down 25%, Dexus about 22%. So that's been kind of the worst of the valuations. Many office and industrial cap rates now sit above 6%, which we think is, very fair levels for the quality of real estate you get there. Industrial sector, they had some of the biggest cap rates expansion over the past 2 years, but their values have held up because of the very strong rental growth. For instance, there's a stock called Centuria Industrial, or CIP. Their cap rates are blown out 160 basis points in the 5 years. So their asset cap rates were about 4.2. They're now 5.8%. If there was no rental growth, that would be 25 to 30% falls. But they've had double-digit rental growth. There's some leases that expired and the new rents are 50% higher. So industrial market's been very strong. The good news about this rebasing of asset valuations is that it's given capital confidence to come back in the sector. So the transaction market's picking up. Mirvac sold a number of assets. Dexus has in the past couple of years. Mirvac's just sold 55 Pitt Street to Mitsui, Japanese investor. Charter Hall Group sold 333 George to the German group Decker. So we're getting a lot more confidence as people realise that earnings are rebasing and values are rebasing. The final point is that a lot of in listed property, a lot of equity fund managers have been underweight the sector because there's been no visibility. It's all been talking, okay, we think office is going to fall further. We're not sure where earnings are. They now have visibility. And we've seen in the past couple of months that the equity investors are starting to invest a bit broader in the sector. They've traditionally just owned Goodman Group and they've been underweight the real estate sector. They're still underweight, but we think that the inbound inquiry is such that we're seeing a lot more interest in the sector.
Well, that's pleasing to hear, Pat. So what do you think are the positive drivers and tailwinds to help commercial property going forward?
Yeah, well, I think the big driver has been the cost of debt. So we've got, the big headwind for the past 2 years has been the cost of debt. So the average for most REITs has been 3%. It's now lifted to 5%. So if you look at it simplistically, it's 66% increase in the cost of debt for many of the REITs, which is a major expense. And so we now believe that we think that's now a pivotal point in the market where we've got rebased earnings, rebased valuations, and we're on the cusp of a Fed cut, we think, next week. They meet 17th, 18th next week. And so we expect that the ECB will cut shortly. The Fed goes, granted, Australia's probably not going to cut rates until next year, depending on your views, but we think that we've now hit peak rates. And so we think there's a number of, good drivers going forward for the sector.
That's great. So they're obviously the positive drivers. So what do you think the biggest risks to the sector are going forward from this point in the cycle?
Okay, so the biggest risk we see, I think number one locally is inflation. US inflation came in last night. It has lowered since July, but as everyone on the call is probably aware, you've got super core inflation, you've got many ways to slice and dice it. The good trend is that it's coming down. The problem in Australia, given the federal government stimulus package, it's kind of opposing, getting inflation down. So that means that inflation here is holding up a bit higher than we would like. So probably the big risk is that rates stay elevated for longer in Australia, and this will delay the recovery in business confidence and capital flows. But we think it's inevitable that rates do get cut globally in all of the markets. Probably, one risk that we talk about, we look at a number of scenarios when we're modelling stocks. The big or worst case scenario would be a hard landing. While we don't believe that will occur, we need to consider these scenarios, but ultimately in that context, rates would be reduced because the government will need to get the economy back on track. And then probably a curveball is the US election. I'm not sure if anyone saw the debate yesterday. Kamala's firmed a bit after that. There'll be a lot of noise in the next couple of months. But interestingly, some US economists think that US GDP would be better off under Harris because if Trump gets in, obviously there's nationalism and tariffs impacting, inflation and the cost of goods over there. So that, there'll be a lot of noise, but we think the big driver though will be the, rates coming down.
Okay, great. So what is your preferred sector at this time, Pat?
Okay, well, probably the starting point as well that I would just like to start with is that unlike other cycles, and despite my youthful looks, I have seen a couple of cycles. One of them was a major supply crisis. supply is completely under control in every market that we look at. And this has been a combination of construction costs, council delays, the cost of debt. So there's a lot of that we have no concerns about supply in any sector. And we think that's fantastic for real estate in the medium term because, I mean, you see it in the headlines every day for residential. That extends across the commercial property market as well. So we don't think there's a supply issue. Um, but having said that, each of the sectors will offer differing return profiles. My personal favourite medium term is office because it is on the nose and people are still sceptical about it, and you still got a slow return to work by the government. But there's some of the office names that are trading at discounts of up to 20% to their already written down NTAs. So NTAs have come down, well, sorry, when you break up if you sell the assets and repay all the debt and divide it by the number of units on offer, that's what we call a net tangible asset per share. That measure has come down, as we saw in the earlier slide, between 20 to 25% for a lot of office trusts, and yet the market's still pricing another 20% falls in that. So one example is Dexus, major office landlord. They've got industrial, they've got a third-party funds management business. Its NTA, is now $9. That's after the 25% falls in office values. It's trading at $7.50. So it implies there's still, for that name, another 10 to 15% further declines in asset values. And then people aren't paying any money for the $40 billion of third-party fund that they manage, which produces 140 million of EBIT. So we can present a case for a $10 share price, $8.50 for the assets, which is still below what its NTA is now. And we'll give it, $1.50 for the funds management business. So that's potentially 40% upside and you get a 5% yield. So we think there's still outsized returns in the office space, but that will take time because a lot of it's sentiment driven. Then another preferred sector is non-discretionary retail. Coming into COVID, we saw the impacts on malls. We underestimated the strength of the consumer. So in our funds, we were underweight, and that did detract relative performance. Going forward, though, we still think non-discretionary is the place to be. And we think it's actually a bit of risk protection as well, because if, not that we think there's going to be a hard landing, we're probably leaning towards a soft landing scenario. But if unemployment rises, which we think it will marginally, people still need to shop. They need to, they need to buy food, clothing, etc. And that's where the non-discretionary retail space comes in. The industrial sector, we think there's pockets of value in the listed sector, but that's still got massive tailwinds of under renting. As I said before, some of the rental growth is at least double digits, so when a lease expires, to pay from what they were paying to the current market rate is stepping up at least double digits. So there's still that tailwind there. And then you see in the papers again, like places like Kemps Creek, where there's infrastructure issues and getting product delivered there. So there's a bottleneck in supply as well. And then the other house favourite, we like affordable and seniors housing. So there's low supply, good price points. There's a lot of demand for available or for affordable housing, but there's just not enough supply of it. And you look at any paper in any city on any day, and it's all talking about affordable housing. So we have a big chunk of our main Maxim fund within that affordable living sector as well.
Okay, that's great. So is there anything that you're avoiding in this sector?
As a general rule, we're still cautious on highly geared stocks because there's a lot of value within the sector where we don't think we need to take unnecessary risks. Like there's some stocks that are trading at big discounts with high gearing, and people are saying, well, maybe that's time to look at these, that if interest rates are falling, surely, and transaction markets are improving, that these firms can reduce gearing and they'll have the tailwind of lower debt costs. We're a little bit, we don't think we need to take unnecessary risk to get that, value, particularly when, I've used the Dexus example. They've got gearing below 30%. There's 40% potential upside there. Why do we need to buy something with 40% gearing, which offers 45% return on our numbers? So we're still avoiding ones with highly geared and complex structures. Cromwell was one of those. They had a web of global assets that's now been simplified, but the European sales don't settle until early New Year. So you never know what can happen in settlements. So we're sticking to, the big cap stocks with lower gearing that offer, strong upside.
Okay,
And then,
great.
sorry, only last week to the Eleanor. I don't know if anyone invests in that, but Eleanor was a stock that suspended. They had issues with their gearing covenants because of their co-investments in the hospitality funds, which are now being sold. So, you know, our kind of modus is that if you think something can go wrong, it probably will. And so it's more like a fixed income mindset. So that's what we're avoiding, anything with high complexity and high gearing still at this stage.
Okay, thanks for that. That's great. So that gives us a good overview on the outlook going forward. So do you just want to give us a quick rehash on why you think the timing is now to look to take a position in the sector and how you can access these opportunities at Charter Hall?
Yep, sure thing. Well, it's pretty simple. There's three key drivers. Earnings have been rebased, values have been rebased, and we think we're on the cusp of interest rate cuts. That augurs very well for defensive asset classes like real estate, utilities, and there's a strong correlation when rates are cut that the defensives outperform. But as we've seen in the past 2 years, when rates rise, defensives underperform because it is an interest rate sensitive sector. When rates go up, people want a higher rate of return for their investments. And so if real estate was offering a yield of 4% and you could have got that in a term deposit, people naturally will go the term deposit and say, well, when you can offer something a bit higher, maybe 5 or 6, then we'll get back into real estate. It's now the reverse will happen in the medium term. So we think, this is an inflection point where rates are on the cusp of being cut globally, and investors have a greater transparency and a rebasing of asset values and earnings. So we think it's a pretty, simple message.
Great, excellent. All right, well, I think that gives us a pretty good overview, and I think we'll open up now for some Q&A because I'm sure there's quite a few questions coming through. So I might just go through some of these, Pat, and if you wouldn't mind just bearing with me. Okay, so the first one is, what is the outlook for M&A, and how do you think this will drive sector returns?
Or is this a planter question, given Charter Hall's group's just made a bid for HPI, which is Hotel Property Investments? As part of the interest rate cycle, there's some massive value, some massive opportunities we think in the space. Stocks that are solid, reliable cash flows that are still trading at massive discounts to net tangible assets, and it's all due to sentiment. So whether it's office stocks, there's some smaller stocks. For instance, we promoting competitors, we in some of the funds bought Dexus Convenience, DXC ticker, 270s 2 weeks ago. It's up to $3 today because there's now speculation that some of these smaller stocks that are trading at 25% discounts, when interest rates get cut, that they're if we don't realize value, then someone else will. So there's some very good assets trading at massive discounts, which we think, just like the direct property transaction market will pick up, M&A. I think Tim Church was in the paper from Morgan Stanley this week saying he thinks this year is the thawing of the M&A market because a lot of people have had these ideas, but there hasn't been capital appetite or confidence or knowing what they're buying. And now that there's a lot more visibility in the underlying earnings and values, I think in the next 6 months there will be, some more M&A.
Okay, great. Thank you. Next question. Do you have a view on how the AirTrunk Blackstone transaction could reshape the data center and industrial sectors?
Yeah, it's good. So the pricing seems incredible, like Goodman to go from $20 to 35 when they've got 14 data centers. But getting included in lots of indices, and we've in the main fund as well, we own a bit of NextDC. So they had a raising 2 days ago that we participated in. There's just global demand, hyperscale facilities. This is a new or a relatively new asset class, but Next, for instance, have been operating since 2010. So they've got great relationships globally. They're moving a bit further into Asia. It's good for Goodman Group, obviously. A very well-run company. At certain points in their pricing, we've had questions about the valuations. It started to come back a little bit of late. We see, still ongoing demand for those facilities for DCs and that the ilk, which will be good for REITs, for those who operate it. I mean, everyone's talking about it now. And even CNI bought a liquid cooling technology company. It's kind of at the tail end of that thematic. But you can't ignore that thematic. It's good for the sector. But equally, we think what it's done is there's a lot of focus on DCs and not enough focus on the deep value stocks that we're looking at. We think everyone's, looking at the headlines, the Goodmans, but there's a tremendous amount of value in the other 30 odd stocks that we kind of model, which are trading at massive discounts. So we think it's if anything, we're actually looking at the value end of the market where we think it's unloved and overlooked.
Okay, great. Now, the next question, are AREITs returning to their favoured status as a great portfolio diversifier for retail investors?
Has it ever changed? Well, I think there's a lot more confidence. I mean, investors have, when COVID hit and the sector was off 35% in a couple of months, it wasn't pleasant. During the GFC, for those who were in there, the sector fell 75% peak to trough. So it is cyclical underlying, but I think the cycle is now turning the other way, where anyone who's been disappointed will actually derive, I think, excellent benefits in the medium term, and particularly direct real estate holders who've, ridden the latest round of devaluations. But I think it's pretty clear talking to management groups that everyone's in this is the trough year camp, and that things are going to get a lot better in the medium term. And now it's a question of your timing, your entry. And personally, for the listed market, there's a strong correlation with rate moves, people getting ahead of the cycle. Whether the Fed moves 25 or 50, I think it's irrelevant. That, it'll signal the peak of the market. And so that's very good for defensive asset classes and in turn, a good diversifier for portfolios.
And the timing on that, Pat, how quickly do you think the markets will take to react to those moves?
Well, the markets reacted a little bit of late. So even in the past month, some of the work gets done prior to the rate cut. So a lot of equity investors anticipate probably 3 months ahead, but the sector hasn't really taken off because of earnings, season, when you've got people like Mirvac guiding earnings lower by 14%, the stock falling 10% on the day. If it was a benign earnings period, I would have expected the sector to be up kind of 10 to 15% in anticipation of these rate cuts, but it was flat last month because of the mixed results, as I mentioned. So I think in prior cycles it probably would have largely happened by now, but I think given the performance of the sector of late, I think that there's very good opportunity this month to get in.
Okay, great. So we have someone on the line that's invested in our DVAP3 fund. Obviously, that is a point in time fund. When do you expect that to close?
It's a good question. I mean, that has been in operation for a while, as the patient investors know, and we thought a couple of years ago that if interest rates got cut, depending on the economic cycle, that could have been a 12 to 18-month fund horizon. It's now been a couple of years. So we think definitely in the next 6 months, those returns will pick up dramatically. And then, obviously, we want the best outcome for everyone. The good thing about the DVAP3 product is that investors can control the liquidity if they want to exit. There's monthly liquidity windows. So if they're happy with the certain returns along the way, they can exit at their choosing. But ultimately, we'll see probably, I'd say by March next year, how the returns are. And, obviously, BDMs will be talking to all the investors as well, but certainly those DVAP, we run a number of opportunistic funds. We started, one over 2 years ago. So the first one we did was at the start of COVID, and we closed that in 16 months, and it made a 40% return. The second one that we started was Institutional Capital. That's still operating after 2 and a bit years. DVAP, it's at about 18 months now, DVAP 3, sorry. And then we had another one that came in September last year. So we've all been waiting for this point in the market. So we think the next 6 months is quite exciting for investors.
Okay, great. Now I think we've got time for one more. Is there good value outside the index?
We like to think so. So part of Maxim's modus operandi for many years has been investing in the stocks that others don't look at, or it's unloved asset class, or it's not institutional quality yet. And seniors housing was one of those that had been in the fund for many years, over a decade, and it's only been in the past few years that Mirvac's bought house here, and you got Mirvac in Serenitas. You've still got lifestyle communities out there. You've got Eureka, but it's now becoming an institutional asset class, and with that comes price appreciation and demand and sophistication in that product. So we like to be part of that. I mean, 20 years ago it was childcare, and now that is a massively institutionalized asset class. Private equity in there as well. So always looking for that. Service stations were unloved, now it's institutional. So always looking for those non-index positions. For the main fund, we try and cap that around about 15%. At the moment, we've got 15% of the portfolio in non-index stocks that include things like NextDC.
Yeah, okay, great. All right, well, I think I'm going to have to call it there because we're getting close to our time and I don't want to keep anyone any longer than we need to. But thank you, Pat. That was a really great wrap up. And we appreciate your time giving us your views on the results period. And just for those on the line, the different funds that we do have available, as Pat mentioned, we have Maxim, we have the DVAP series, which is a point in time, deep value partnership fund, and then we also run mandates to specific needs. So if you've got any questions on those, please reach out to your BDM or your team. For those questions that we didn't get to, I will make sure that Pat, myself, or the team come back to you shortly. But I'd like to thank you all again for your time today, and I hope that you found this session of interest. Thank you and have a great day.
Thanks, everyone.